Hey guys, today we're going to talk a little bit about how you can use your life insurance policy to pay for your child's college education. So if you're familiar with whole life and how cash value builds up, your cash value is how you're going to be able to take a loan out and pay for their college education. If you go onto Google and you type life insurance cash value illustration, you'll find some handy websites which give you an example of how this works. So again, if you know what cash value is, or if you don't know what it is, let's go over it briefly. When you get a whole life policy, cash builds up inside your policy. So, for example, if you get a $500,000 death benefit and your annual premium is $10,000 a year, at the end of the first year, sometimes you may have zero cash value built up inside your policy. Depending on the policy you get, sometimes you can have 50-60% of what you've put in available to you. It really just depends on how the policy is set up. But now let's look at year number 2 and year number 3. You can see you're getting dividends being paid out, right? Every year you get dividends paid out and your cash value starts to grow. So within 5 years, you may have put in $50,000 in premiums, but now you have $25,000 in there as cash value. Now, what can you do with cash value? Depending on the policy you have, sometimes you can pull out 70-80% of your cash value as a loan against your policy, and then you can pay that loan back to yourself later. So the way these dividends work, the policy that you have, you may be getting 4% or 5% interest, and your cash value will be growing year over year over year. So let's say you start this at the age of 30, and then by the age of 40, 10 years later, you have 74,000 in there, right? Maybe your kid turns 18 and now it's time for them to go to college. By the time you have had this policy for 14 or 15 years, now let's say you have 134,000 in there in cash value. Maybe their college education is going to cost you 34,000. If only it was that cheap, right? But let's say you pull out 34,000 for the college education. Now you're going to have 100,000 left in there of cash value. You're going to continue building interest on your cash value. So depending on how the policy is set up, sometimes you continue building interest on the remainder cash value. Sometimes you get interest on the full cash value even if you pull some out. So let's say you pull out $34,000 loan from your policy, and now you're paying 4 or 5% interest on this loan, which you got immediately, no questions asked, no credit checks, right? This is your money. Now, you're paying interest on 34,000 as you're paying it back to your policy, but you're receiving 4 to 5% interest on that 100,000 you still have left in your policy. So, it's not a free policy, but if you think about it, you're paying 4 or 5% on 30,000, but then you're receiving 4 or 5% on 100,000. This is how you can pull out money from your life insurance policy if you start early enough and build up a good cash value to pay for your child's college fund. Or if they decide they don't want to go to college, go buy yourself a new car, right? Instead of getting a finance through a bank, paying a high interest rate, them forcing you to get full coverage insurance now because it's financed, you can just pull out cash from your whole life, buy that car in cash, and then slowly pay back your whole life while your whole life continues to build interest and dividends. Hopefully, this was helpful, and now you understand a little bit about how cash value builds up within an account and how you can take a loan from that cash value to pay for certain things. Thank you.